Welcome to This Week in Crypto from K33 Research. Today is August 21st, 2026. If you want to dive deeper into any of the topics we cover today, you'll find all of our research at k33.com/research. This week, Washington moved crypto regulation back to center stage. President Trump met with crypto and traditional finance executives to push the Clarity Act forward. At the same time, the SEC proposed a separate regulatory path for token projects that doesn't depend entirely on Congress. And away from regulation, the United States Treasury announced larger buybacks of long-dated government bonds. Markets interpreted that as a step toward easier financial conditions, while Bitcoin rallied from roughly $63,000 to above $79,000 during the week. There is quite a lot to unpack. Let's start at the White House. President Trump met privately with executives from both crypto and traditional finance in the Oval Office this week. The focus was the Clarity Act, the broad market structure bill intended to establish clearer boundaries between the SEC and the CFTC. The discussion centered on what remains unresolved, which senators still need to come on board, and how to move the legislation forward after the recess. The next important date is September 15th. That's when the Senate is expected to hold its first procedural vote on advancing the bill. If that vote fails, the prospects for comprehensive crypto legislation during this Congress would weaken considerably. The White House meeting doesn't resolve those political disagreements, but bringing together firms such as Coinbase, Robinhood, Nasdaq, and ICE under the same roof is notable. Crypto market structure is increasingly becoming a discussion involving both the crypto industry and the traditional financial infrastructure it is gradually integrating with. The United States Strategic Bitcoin Reserve also came up. Trump was asked whether the administration intends to accumulate significant amounts of Bitcoin or other crypto assets. His answer was that the idea has been discussed, but that any decision would be left to his advisors. So there was no new commitment to buy Bitcoin, and there was no indication that additional purchases are imminent. That's an important distinction. What the comments do show is that the idea remains part of the administration's broader crypto agenda, rather than something that has disappeared from consideration. What's particularly interesting is that Congress is no longer the only route being pursued. The SEC is moving in parallel. Under chair Paul Atkins, the agency has proposed a new framework called Regulation Crypto Assets, designed specifically to create a more workable path for crypto projects to raise capital and launch tokens in the United States. The proposal includes two new fundraising exemptions. A smaller startup exemption would allow projects to raise up to $5 million over 4 years. A broader exemption would allow them to raise up to $75 million over 12 months, subject to an offering statement, financial disclosures, and ongoing reporting. So this isn't a return to the largely unregulated initial coin offering market of 2017. The idea is closer to creating a simplified crypto-specific public offering framework. But the more important part may be how the SEC treats the token itself. The proposal explicitly separates a crypto asset from the investment contract, through which that asset may initially be sold. In practical terms, a project could sell tokens through a securities transaction while the network is being developed, without the token necessarily remaining subject to securities laws forever. Under the proposed safe harbor, that investment contract could eventually end once the issuer has completed or permanently stopped the essential development work promised to investors. The issuer would document that transition through a filing with the SEC. That creates a much clearer life cycle. Raise capital under a regulated exemption, build a network or application, complete the promised work, and potentially allow the token itself to transition outside the SEC's investment contract framework. That's a very different philosophy from the previous regulatory approach. Rather than forcing crypto projects into existing securities rules and then litigating the boundaries afterwards, the Atkins SEC is trying to define an explicit route for compliant token launches. Clarity remains the more consequential long-term framework because legislation can provide greater durability and clearer boundaries between agencies. But the message from the SEC is becoming clear. regulatory progress doesn't necessarily stop if Congress struggles to get the Clarity Act across the finish line. The other major story this week came from a very different part of Washington. The United States Treasury is doubling the maximum size of its planned buybacks of long-dated government bonds from $2 billion to at least $4 billion per operation, starting September 9th. Treasury Secretary Scott Bessent has also indicated that the purchases could become larger. It's important not to confuse this with quantitative easing. Treasury isn't creating new money to buy bonds in order to stimulate the economy. It is buying back older and less liquid government securities to improve market functioning, particularly at the long end of the yield curve. Still, the signal matters. Long-term Treasury yields have remained elevated, while government debt issuance is heavy. By expanding these buybacks, Treasury is showing a willingness to actively support liquidity in that part of the market. Bessent has also argued that long-term yields have become disconnected from underlying fundamentals and described the objective partly as keeping the market in equilibrium. Markets interpreted the announcement as incrementally easier financial conditions, and that's where the crypto connection comes in. Better liquidity and greater official support for the Treasury market can reinforce the broader liquidity and currency debasement narrative that tends to benefit scarce assets. Gold strengthened, and Bitcoin moved from roughly $63,000 at the beginning of the week to above $79,000 by Friday. We should be careful about attributing a 20% Bitcoin rally to any single announcement. But the timing is notable, particularly after the extreme inactivity and low volatility we have been discussing for several weeks. A few other developments are worth keeping on the radar. The HYPE token rallied after Trump said the CFTC is working to bring Hyperliquid into the United States in a fully compliant way. Democratic Senator Ruben Gallego said Congress could still get the crypto market structure bill across the line despite ongoing disagreements around ethics. And Strategy raised another $334 million through sales of MSTR shares, while making no Bitcoin purchases or sales and taking its dollar reserve to $4.8 billion. Stepping back, this week feels less like a collection of isolated crypto headlines and more like several parts of the same story. The White House is pushing Congress toward a federal market structure framework. The SEC is simultaneously building a regulatory route that can function even if Congress moves slowly. Traditional financial institutions are increasingly part of the same conversation. And Treasury policy is once again influencing the liquidity backdrop for Bitcoin and other scarce assets. Crypto isn't waiting outside the financial system for somebody to decide whether to let it in anymore. The boundaries between the two are increasingly being built in real time. Thank you for listening to This Week in Crypto from K33 Research. Subscribe for weekly crypto market updates, and remember to visit k33.com/research for our latest analysis and research.